In this video, we will discuss the concept of deferred tax liability, DTL. The reason there is deferred tax liability in the balance sheet is because we use different depreciation method in the accounting, which is the financial statement, and in the tax return. Let's look into one example, and then you will understand why there is deferred tax liability and how to calculate the deferred tax liability. Let's say there's a company, and the income of this company is $4,000 a year. So here when I say that it is 4,000, it is the revenue minus the cost of goods sold, minus the other administrative expenses, minus the interest expenses, but it is before the depreciation. So in order to calculate the pre-tax income, we have to know what is the amount of depreciation. Let's assume that they have assets which is $6,000. When they do the accounting, they try to depreciate the assets for 3 years. So each year it will be $2,000. So totally they will depreciate all the $6,000 in 3 years. Now what is the pre-tax income? The pre-tax income is going to be the income before the depreciation minus the depreciation. So this is $2,000 for every year. Then how about the tax expense? The tax expense is going to be the pre-tax income times the tax rate. Let's assume the tax rate is 30%, then this one is going to be $600 for 2005, and similarly for 2006 and 2007. So the total tax expenses in the 3 years is going to be the sum of this number, which is $1,800. So up to now, everything is pretty straightforward. But please remember that you have to recognize this term, pre-tax income and tax expense. These two terms are associated with the accounting method. So these two terms will appear in the income statement. Then how about for the tax return? For the tax return, you are allowed to use different depreciation method. First, for the income, they should still be the same as the accounting method before the depreciation. So this is also 4,000 in 2005 and same in the rest of the years. But let's say for the tax return purpose, we try to depreciate the assets by 2 years only. So it's going to be depreciate $3,000 for the first 2 years and only $0 for the last year. So the sum of the depreciation is still equals to 6,000, but we accelerated the depreciation in the first 2 years. So what is the effect? Because of this accelerated depreciation, then you will see that the taxable income is going to be less than the pre-tax income. The first year is only 1,000. Second year is also 1,000. But however, for the last year, the taxable income is 4,000. So you see that by accelerating the depreciation for the tax purpose, we pay less tax in the beginning years, but we pay more in the final few years. And similarly, the tax payable is going to be the taxable income times the tax rate, which is 30%. So you see that the first 2 years, we only have to pay $300 each year, but the last year we have to pay $1,200. Then how about the total tax we have to pay? It is $1,800. This is exactly the same as the one we use the accounting. Okay, so when we come to here, you will see that why there is deferred tax liability. When we do the accounting, including the balance sheets and income statement, we say that we actually have to pay $600 for every year. But for the tax purpose, we only pay $300 for the first 2 years. So it means we owe the government by the tax expenses minus the tax payable for the first year. So it is $300. And similarly, in the second year, we owe the government by $600 minus $300 and then plus the deferred tax liability accumulated from the last year, so it is $600. But in the last year, we only have to pay $600, but we paid $1,200. So as a result, we are paying more than what we should have paid. So this is negative $600. It's not a deferred tax asset. But don't forget that we have to add this to the last year's deferred tax liability balance, so the deferred tax will become 0. So in summary, first, please make sure that you understand for accounting, you have to use pre-tax income and tax expense as the terminology. For tax return, we use taxable income and tax payable. You must remember these terms. Secondly, there is deferred tax liability. It is because we use different depreciation method. And since we depreciate more in the tax return, so we pay less tax. As a result, we have the liability to pay more in the future. And the last thing I have to mention is that you have to remember this equation. The tax expense is equal to tax payable plus the change of the deferred tax liability minus the change of deferred tax asset. We will learn how to use this equation in the coming videos.